Welcome back, friends. My name is Deepak More. You are watching my YouTube channel, TheIndianOptions.com. Today we are going to discuss about a video called as Rationale behind 75% of wins. This video is coming in from the section Miscellaneous and Conclusion section, and this is the second last video in this whole video series. This is the 85th video, and hooray! Okay, I just felt like doing that. Anyway, so the rationale behind 75% wins. So in options, actually we can win more than 75% of the times. But winning 75% of the times doesn't mean that you would be in profit, or you would because as in the introduction also I had taken that example. Like if you are winning 75% of the times, and every time if you are winning say 100 rupees, and in the remaining 25% of time if you are losing 800 rupees every time, then you will still be in loss though you are winning 75% of the times, right? So winning 75% of the times is not really a very key indicator here, but it helps. It helps a lot. It helps, I think so, emotionally more than realistically, right? Now the thing is that because the reason why I'm saying is that it is helpful, because if you lose some money or something, then you know that 75% of the times you win, so maybe you will be able to recover this money maybe next time, or next time, or at the most you will be thrown back maybe 5 to 10 days until you recover these losses or something. So to get this kind of feeling, which is really a personal feeling, you actually have to track these wins, because it's really very important. It gives a very important moral support when you are losing money, or when you are actually making the money. It will make sure that your behavior is still intact. Okay, because if you make say 1 lakh rupees, and then and it is like, then you always have a fear that almost 75% of the times you have I have won this 1 lakh rupees, maybe 25% of times I'm going to lose, so maybe I'm going to lose this tomorrow or day after tomorrow, or a week later. So you are actually being very careful in that situation, right? So the numbers, they are really very important to give you the moral support. Now throughout my videos I have been explaining, like we are almost on the second last video of our whole series. So in all these 85 videos I have been saying top of my lungs that option trading, on one hand it is really very risky if you don't know anything what you are doing, period. You are going to lose your money, and all your money, and maybe more. Okay, if you don't know anything about what you are doing. But if you know what you are doing, then you have a really very big wide spectrum of risk to reward ratio. Okay, so it's really a wide spectrum. On one hand you can have 100% risk to your capital, and you can earn maybe 200-300% per annum. That is also possible. And on the far end of a spectrum, you can have 0 to maybe 10% risk to your capital, and you can earn like 20 to 25% very easily per annum, right? So now where do you want to sit in this spectrum is your own choice, right? It's not the options that is actually forcing you to do something. It is your choice where you want to take, how much risk you want to take, opposed to how much reward you are expecting out of it. So all this is your doing basically, right? Now if you look at this chart, I have drawn some timeline here. Now start from the right to left. Try to read from right to left. So here I am saying is 0 to 10% of risk to capital, and you can earn maybe 20% or so per annum. Okay, very less risk to capital, almost no risk to capital, but you can earn only 20% or so. Now going to the next line, 30% risk to capital, maybe you can earn 40 to 50% of per annum profit, right? Next is 50% risk to capital. Maybe you can earn like 70% or so per annum, right? And again, more like 70% of something risk to capital, you can actually earn maybe 100% or so very easily. And then the final one, you have like 100% risk to capital, and then potential to earn maybe 300 to 400%. Now, whenever you are doing trading, you are going to witness lot of profits and lot of losses in your game. Basically, this is game. It's a money game basically, right? So which profit or which level of profit that you want to take is really very, very important. You have to make your decision initially, because sometimes you will see that you can make maybe 100%, but I really would suggest that you don't take that 100% today. Because what will happen is, once you know that you can take that 100%, tomorrow again you are going to go and attempt to take that 100%. Day after tomorrow again you are going to go and attempt to take that 100%. And in a way to do that, you might someday lose 100% of the capital. And if you lose your capital, then you are done with it. You cannot trade from tomorrow. And then you'll have to sit until you again get the capital from somewhere, and then you will start blaming the options that, okay, I lost a lot of money in options and it is very dangerous. It's not so. Basically, how much profit you want to take, you can actually demand, and you can play, or you can put your trades accordingly and just get that much. Or if you are satisfied, in my example also, in my lot of videos I have taken the example, whether you want to take like 1 rupee, 5 rupee, 10 rupee, or you want to go for a 1000 rupee note or 2000 rupee note, your choice is yours. If you start taking 1000 rupees note, 2000 rupees note, the chances of you losing that much from your own pocket is really very high. On the other hand, if you take 5%, 5 rupees, 10 rupees, 15 rupees, and if you keep on, adding that, continuously, almost on daily basis, market is open like 220 days in a year. And if you are getting like 10 rupees, 200 days, it is going to be 2000 rupees profit, man. Like 2000 rupees profit. Which stock will give you 2000 rupees increment in a period of 1 year? It's really very few, and the chances of finding such stocks and the timing and everything should match actually, and it's really very difficult to have that coincidence come in your way. It's really very difficult. So again, I'm saying that it is a wide spectrum of risk to reward profit ratio. Where you want to sit, it depends on you. Okay. Now going to the next slide. Now here I am saying that you can earn at least 50%, and the assumptions are as follows. Like, you are opening a call sell or put sell kind of contract, and you are opening equal amount of lots on both the sides, and both of them are out of the money, and strike price is at least 300 to 400 points away from the market trading at point. You have calculated your break-even points properly, and you have already worked out your risk reward and probability ratios properly, and you have already have your max loss and max profit already calculated. So once all this thing is done, then the next slide I am explaining like how you can get at least 50%, right? Now if you look at the left side of the figure, you will see that this is actually the option chain. You can see the call side and put side, and here I am saying that if the market is trading at 12,000, I am taking it as an example, then you should choose the strike price as 11,700 on the put side and 12,300 on the call side. And say for example on the put side you are getting a premium of say 100 rupees, and then you have chosen the stop loss of 140, and you have chosen the profit target of say 60, and on the call side you say for example you have got a premium of 70, and your stop loss you have set it at 100, and profit target you have set it at 40, right? So and these are all put sell and call sell kind of contracts. So at expiry, the market, if it is at 1200, there are three things that could happen, right? It could go below 11,700, that is one option, or it can go above 12,300, that is second option, or third option is that it would stay between 11,700 and between 12,300. These are only the three possibilities that could happen at expiry. Now actually if you look at it, the market can either go one side or the other side. It cannot be at the two places at the same time. It cannot be below 11,700 and about 11,300 at the same time. Doesn't work that way, right? So so what I'm saying is that in this situation, at least one side you are going to make profit. If you open one lot on put side, one lot on call side, one side you are going to make profit, either put side or call side. So at least you are winning 50% of the times here, right? So it means that you are won 50% of the times. So now let's talk only about that extra 25% of time, between 50% to 75%. Now for that, to get that 25%, it is a bit difficult. I wouldn't say it is impossible, it is a bit difficult, and you will have to play a little bit of permutation and combination, and you will have to adjust your trades a little bit here and there to achieve that 25%. I am going to show you how. Okay, now in this figure, to get extra 25 points, now you see that I have added the break-even points here. The lower break-even point is 11,530 and the above the upper break-even point is 12,470. Now here I am just adding the premium to that strike price and subtracting the premium on the put side on the strike price. Now your actual boundary of making loss is this. So if the market goes below 11,530, then you will start making actual loss. Or if the market goes above 11,470, then you are going to get start getting loss, right? Now I have taken the break-even point is 170. Why? Because on put side you got 100 rupees and on call side you got 70 rupees. So total becomes 170. 170 is the premium that you have received for this whole structure, right? Now this is actually the strangle, short strangle, which we have already learned in one of the strategies, that is short strangle. This is the short strangle actually. Now in this what happens, if the market is between these 2 points, 11,530, 12,470, then you are going to be winning. It is going to be treated as you have won like this trade, right? But if your market is between 11,700 and 11,300, which is the strike price, then you are going to win both the sides. You are going to win the complete 170 rupees. But if it is below just the BEP but above the strike price, in that zone you will have to give back some of the profit or something. So the real loss is actually 470 points away, right? Now if you set up the loss properly, and if the market starts to go, if it has crossed the 11,700 point, 11,700, then you can just quit the trade, even though you will be in a profit, because you have got 170 rupees, right? Now half the time, like if you wait, if nothing happens for say 15 days, in 15 days actually half of the time decay will be already gone, which means that you will be able to get 50 rupees on the put side and 35 rupees on the call side. You already got 85 rupees, then you can just quit the trade. So that is also one thing that you can do. And if you are really going into the risk, then actually you can put one more hedging trade above that 11,700, and you can put that hedging trade at say 11,800 or something, or 11,600 or something on the put side, and on the call side you can put the hedging trade of at say 12,400. in that case maximum loss you are going to make is 100 rupees. So okay, fine. So if we do all this kind of permutation and combination, then you can very well earn that 25% over that. Okay, so just consider this, and if you are doing these options really for a really long time, you will know what I'm talking about. It is very much possible to get 175%, but it is very difficult to reach 80% or 82% or 85%. So between 70 to 80%, most of the traders, they can achieve 70 to 80% in the options trading, right? So that's about it for this video, and thank you very much for watching my YouTube channel, and please subscribe to my YouTube button. The YouTube button is right here, the subscription button is right here, and thank you very much. I'm going to upload this presentation to my YouTube to my website www.theindianoptions.com. Please download it from there. Thank you very much, and you have a nice day. Bye bye.